Hey everyone. I'm going to give just a brief introduction on Synthetix in case anyone's not familiar, and then we'll do a bit of a walkthrough of the system. So Synthetix is a synthetic asset platform on Ethereum. Essentially what we allow people to do is have exposure to a bunch of different assets, crypto assets, fiat currencies, commodities, etc. And hold them on Ethereum as a synthetic asset without having exposure or having to hold the underlying asset. So for example, we've got a gold token, so you can hold that token and it essentially represents the price of 1 ounce of gold without having to actually have custody of the gold itself. And we've got some more, exotic assets that we've just launched recently. So we've got an index of exchange tokens. So if you're really interested into centralized exchanges or into shorting them, we've got an index of BNB, Leo, Orbi, OKEX, and KuCoin. So, if you think that sector of the token industry is overvalued, you can basically buy a token that will give you inverse exposure. So if the price goes down, the value of the token goes up. Or vice versa, you can hold the token, and if it goes up, then the price of the token will go up. And the way that this works is similar to Maker. So Maker, you lock ETH into a CDP, and then you issue a synthetic US dollar called DAI against it. Our system works very similarly. So you've got our token, which is SNX. You lock that token, and you issue debt in the system. The big difference is that at the moment we have, using price feeds, so hence the Chainlink conversation, the ability to reprice that debt. So you can start with debt that's priced in US dollars, and you can convert it into synthetic Bitcoin or these other assets. So we'll just do a quick walkthrough of the system. So this is Minter, which is our CDP creator, if you will. So this is where holders of the SNX token can go to lock their SNX and issue new debt into the system. So we'll connect via MetaMask here. So you've got a balance of SNX, which is worth about $30,000. So this is on Koban, I think. We've got roughly $30,000 worth of collateral that's in this wallet, and against that collateral we're going to issue some debt. So I think at the moment we've got about $2,000 worth of debt that's already owed, and there's about $4,000 worth of debt in this wallet. So the collateralization ratio here, if you're familiar with Maker, you know that Maker has a target threshold of 150%. So if you fall below 150% collateralized, you'll get liquidated. With us, our target is 750%, so it's a lot larger buffer. And the reason for that is obviously ETH is a lot more liquid than SNX, and so there's more risk with the SNX token of the value dropping or moving. It's a more volatile asset. So what we're going to do is we're going to go and mint some new debt in the form of SUSD, and we're going to essentially lower that collateralization ratio to 750, which is the target rate that we've got in the network. So hopefully Koban will go quickly for us. Okay, so basically what we've done is from 0x address, we just created this new SUSD, so it's been minted, and it's now in the wallet. And if we go back, you can see that the debt that's owed is now $4,000. So in order for you to release all the collateral and be able to fully transfer it again, you need to burn that $4,000. So that's kind of the basic mechanics of issuing debt into the system. But that's not really the point of the system, right? So the point of the system is to allow people to have exposure to these different assets, right? So, okay, great, you've got SUSD now, which is tracks the US dollar. But if we go over to Synthetix Exchange, we can see where the good stuff, the fun stuff happens. So we'll connect to Synthetix Exchange. And you can see this wallet has, a bunch of different things in it. You've been trading a lot, it looks like. So we've got an inverse Tezos token, right? So he's a bit bearish on Tezos here. We've got some gold, we've got some USD, and we've got some Bitcoin. And so basically all of these different assets are tracking the prices via a price feed, via an Oracle feed, being pushed into main, or in this case, into token. So what we're going to do is we are going to buy the centralized exchange token. So if we go down here, so we're long Leo, I guess, at this point. So we can, and the centralized exchange token is a basket of tokens that tracks about $1,000 price target. So it's made up of a certain number of units of each of the different tokens that constitute the basket. And the price target is about, launched at about $1,000. So it's down to about $950. So maybe we should actually buy the inverse one if the market's going the other direction on this. So we can buy with $1,000 the inverse centralized exchange token. So if you want to go ahead and do that transaction. And so essentially what's happening here is the contracts are taking the SUSD and burning it. So it's taking that debt that exists in the system and burning that value, and then it's going to issue this new inverse centralized exchange token. So basically we've sent to 0x0 the USD, and then we've minted the new value of the centralized exchange token. And then down here there's another transaction which is happening, which is the fees. So the exchange charges fees. And this is how the minters, the people in the system who are providing the collateral and who are collateralizing the network, are rewarded. So for every single exchange that happens, there's a 30 basis point fee that's charged, and that's paid to collectively the pool of people that are staking the network. So they're the ones that are essentially taking the risk and facilitating the transactions and allowing people to trade. So, yeah. So yeah, if we go back to Minter, you can see in rewards there. So on a weekly basis, all of the fees are pooled, and based on your proportion of the debt, so based on how much value you've created in the system, you're able to claim your fees. So it looks like we've got about $11 worth of fees to be collected here. And then on top of that, we also have an inflationary supply. So that's in the early phases as we're bootstrapping, as we're waiting for the transactions on the network to be sufficient to incentivize people to stake. We've got this inflationary supply. So you're basically paid in SNX tokens for taking this risk right now. And that inflation over time, over the next 4 years, declines, and eventually we hope to get to a point where the actual transaction fees themselves are sufficient to secure the network. So
like if you look at the SNX balance, right?
Yep.
Right, and then we go to rewards. I claim and I can mint again.
Yep. So yeah, we'll claim those rewards. And then we've got more collateral. So we've got some SUSD that's been claimed from the fee pool, as well as this inflationary supply that will increase the collateral value of the wallet and can be minted against. And so, I guess the intent here is that you have something similar to Uniswap, in that you've got this pooled collateral model where anyone sitting here can go and purchase debt and can trade against the contracts, essentially, right? So all of the people who are staking SNX providing collateral are this pooled counterparty. So we're all sitting over here saying anyone who turns up the contracts can trade with as much value as they've got in debt and can reprice that debt. And we will act as a counterparty to those trades. And we're rewarded with fees from the transactions. The same way that liquidity providers in Uniswap put up ETH and tokens and allow you to trade against that and then collect the fees from those trades. Yeah, so his ratio is a little bit higher and he can mint again if he wants. And so I guess at the moment we've got about 30 different assets that you can trade. So a bunch of different cryptocurrencies. So you can see on Synthetix exchange if we just head back over there. So that's the list of all the assets. So you've got some fiat currencies, commodities, crypto, and then now some indexes. But eventually the idea is that we'll also have things like synthetic Tesla. right? So if someone doesn't have access to a brokerage account, so they're in an emerging market, or for whatever reason they can't access, a broker, they would be able to theoretically, provided they've got ETH, come to Synthetix exchange and get access to Tesla or Apple or some other equity, or potentially even like the S&P 500. And the way that works is that the counterparties, i.e. the SNX holders who are providing collateral, would essentially act as the counterparty to those trades to allow people to access these more traditional assets, and then against those assets they would hedge them. So in order to I guess maintain that equilibrium within the network, us who have brokerage accounts who can potentially act as market makers are able to keep the system in check essentially, and we're paid a fee for that. So over time, we expect that there'll be a whole bunch of different assets, indexes, traditional assets, cryptocurrencies, etc. And anyone in the world who's got access to ETH, who's got an Ethereum wallet, will be able to get exposure to those assets. So that's it. Any questions?
What kinds of assets can I look up as collateral?
It's actually SNX, so it's our token, and that token derives its value from the fees. So there's a fee yield from that.
So when the first drop of Bitcoin was made, there was the headline from the New York Times, like banks on bridge of bailout.
Yeah.
Isn't this pretty much the mechanism that like blockchains and cryptocurrency wanted to move away from? In the sense, like, if I'm as a user on a platform want to get exposure to a token, like say some token that exists as an ERC20 token already on the Ethereum blockchain, I can buy it here, but I'm not like holding anything on the actual supply of the token. So that you will have like a virtually inflated supply, and therefore like if you get enough traction, you will effectively get an inflation even in deflationary tokens.
Yeah, that's actually a good point. So the question was, what's the impact on the actual spot market, right? What's the impact on a token market if you're creating these derivatives that are synthetic, that are not sort of tied to the actual underlying collateral? And I mean, I think we have that in traditional markets, like the gold spot market's much smaller than the futures market, right?
Yeah, definitely, we have that in traditional markets already.
And so I guess the question then is, does that introduce risk into the systems? I suppose the way that the system is sort of calibrated is that the debt is capped by the value of the collateral, right? So the collateral constrains the supply. So it can't just infinitely expand, and we can't increase the value of the collateral unless there's more activity being captured. So it's a little bit like backing derivatives based on the actual transactions happening on the derivatives exchange. So it's somewhat circular, but it is also constrained in what it can accommodate.
Yeah, but effectively, like I'm putting a lot of SNX if I'm away, right? And I buy a lot of SNX, so then I will lock up on my SNX, which decreases the supply of SNX, and it will drive up the price of the SNX token, and it will effectively drive down the price of whatever I'm giving myself exposure to, because I will then be able to sell this to the market if people accept these tokens as an alternative to actual like the tokens are supposed to represent, then you're kind of inflating the supply of any kind of assets.
Potentially, but because the price is derived from a price feed from the spot market, it's somewhat hard for that the derivatives market in this case to kind of feed back into that, because it's not a counterparty based market.
Like they could either go to the spot market and buy something, or buy something here. So it's like if I'm choosing to instead get the derivative token, then there's less reason for people to hold the actual tokens.
Correct. So, like, in the example of Tesla, let's say, right? So Tesla, there's a certain number of people that have access to buying Tesla in the world, right? And this would expand the amount of people that could access Tesla, potentially, right? The question, I guess, is, would it sort of cannibalize the existing demand for Tesla in the spot market? I think we see in the gold market that doesn't really happen, right? Like the futures market is still driven by the spot market. The same thing with oil. Like the things that are being traded on spot markets are constrained by reality, right? We're just taking feed from that counterparty-based market and then allowing people to have access to that those same assets. So, like, yes, potentially in the long term there could be some feedback mechanism between the two, but I don't know that it necessarily spirals out into some kind of huge inflation of the supply of that asset because of the way that the prices are derived.
Because like the market makers need to interact with the spot. Like the market makers for the derivatives need to interact with the spot market usually through like some kind of like margin protocol.
To hedge or whatever, yeah, ideally, yeah, to keep it in line, yeah.
You need to work your way through the layers. Right?
Yeah, I mean, so if you take the example of Tesla, and imagine that right now the latent demand in the existing market, for people who want to hold Tesla, is X, right? And if we expand that to every single human who can access an Ethereum wallet, maybe it's 2X, 3X, whatever. How does that feed back into the spot market? It's through the market makers who are sitting on the other side trying to hedge, right? So if this significantly decouples from the spot market, then they'll go into the spot market and buy. But obviously, you need massive scale, and we're not there. It's still early. So.
Hi, great product. I was just wondering, have you guys had many issues from a regulatory perspective?
Yeah, I mean, when we're talking about providing access to regulated assets like equities and things like that, then yeah, that becomes potentially problematic. We have some level of permissioning in the system at the moment, so we provide the oracles, but obviously, we're here to kind of get away from that a little bit and decentralize that. I think there is some sufficient level of decentralization where it's running on Ethereum. The oracles are decentralized. The governance of the protocol is decentralized, and you can somewhat avoid regulatory issues. One of the reasons why we've been able to avoid it to date is that we're not matching counterparties. So we're not providing a trading venue per se. The debt never leaves your wallet. So you've got debt priced in gold, and then you just reprice it in silver. There's no order matching going on there.
So you're not the counterparty.
We're not the counterparty, yeah, exactly. So that's how we kind of avoid it for the short term. Once you start listing Tesla and Apple and things like that, then it becomes interesting. So.
Are the assets listed elsewhere right now, or just Synthetix?
That's a really good question. So you can imagine, you've got this venue, right, where people can bring debt and they can trade that debt, but they need to be able to get in and out, right? And so you need a bridge between Ethereum and this debt market. And the way that we've set that up is through Uniswap. So we've got the fourth largest pool in Uniswap, similar to wrapped ETH, where people use that as a bridge to get into some of the lending protocols and what have you. Our synthetic ETH is matched in Uniswap to ETH, and we've got about, I think, 5,000 ETH on either side of that pool. So you can move sort of $10,000 to $15,000 with pretty low slippage in and out of the pool.
Also, if I have a synthetic ETH and I want to move it out, I can withdraw actually.
Correct. Yes. Yeah. There's a bi-directional bridge that way. Yeah. I mean, again, it's still fairly liquid, but if it's 10 or 20 grand, then it's usually pretty good. So, if you want to go out to like 3 months, you can see, so that's kind of the growth of the pool over the last 3 months as we've incentivized people to put ETH into this Uniswap pool.
So, if I understood correctly, you are the market maker right now, so you're on the other side. Like if everyone just goes and buys Tesla, you try to hedge it, and if on the other side, so you kind of equalize the market, right?
So we're not. So all of the token holders are. So collectively, there's about 1,000 people that are minting right now. We don't have those equities yet, so there's no real need to kind of hedge out into the spot market. But eventually, over the long term, yeah, we would need market makers that were essentially hedging their exposure to the pool of debt in the system, external to the system.
Okay, so I'm just trying. So it sounds like you can get into this trade, and that doesn't have to be another party to take the other side. So the market itself could be directional.
Correct.
Within the system, which
Yep.
means that if you have like small number of people supporting the market, the makers, they can become directional as well in the opposite direction.
Correct.
So if the black swan event happens, it can go down.
Absolutely.
It's not neutral. So
Correct.
how do you
Yeah.
kind of deal with this risk?
Yeah, so I mean, I guess if you sort of imagine it in a traditional market, it's like you've got this clearinghouse, right? And you're internalizing all of the flow through that clearinghouse and not kind of hedging it externally. One way we avoid that is there's just a large buffer, right? So, I think the second largest asset is ETH, right? The other way is that most of the assets being held are crypto, and SNX is also crypto, so they're highly correlated. But eventually, over time, as we launch the next version, there will be kind of built-in balancing mechanisms. So if you have a position open in Bitcoin, for example, there'll be a margin cost to maintain that position, and then we'll like a futures exchange, pay people who are taking the other side of that. But ultimately, there still needs to be some hedging outside the system, and we expect, as the system scales, that more sophisticated market makers will come in and take that over, because if you're just sitting there internalizing the flow, then eventually you're at risk, right?
So you're hoping that big institutional investors will come in and
or even crypto hedge funds, crypto market makers. There's fairly sophisticated actors in the market now already that I think would be able to, if not perfectly hedge, at least hedge enough that the trading fees will be sufficient to offset the risk. That's the idea. Cool. Okay. Thanks very much, everyone. Appreciate it.